we get everyone to introduce themselves quickly and to make a start, and then I will introduce the topic.
That's good. Thanks, Karen. My name's Brian Love. I'm Head of Regional Broking in London for Renewable Finance. I've been in financial services for 15 years across retail and commercial funding. Last 5 years of that was in a specialist commercial finance broker specialised in healthcare, hospitality and leisure and retail, and now heading up the renewable division of building out a commercial finance brokerage focusing on property, commercial asset finance. Thank you.
Thanks, Karen. I'm Darren Willoughby. I'm Managing Director of 2X Commercial Finance. We're a national commercial finance brokerage with 7 offices across the UK. Established just approaching 15 years now, and we're whole of market for all things business and commercial. Thank you.
Hi there, I'm Jo Sutton. I'm from Empire Finance. We're a commercial finance brokerage based in Leicestershire, but we also are nationwide. We cover sourcing finance for all types of business purposes. We are quite heavily in the property market. And we have been running for 7 years.
Cool. Thanks very much. I guess that's me. Yeah, so Mike Cass, I'm head of secured and structured finance at capitalise.com. We've been going sort of 5 or 6 years now, based in London. And what I cover is sort of anything property finance related, so short and long term, but also anything kind of transactional, management buyouts, acquisitions, MBIs, anything sort of around that.
I'll start the Ortus introductions. My name is John Salisbury. I'm the Managing Director of Ortus.
Hi, I'm Richard King. I'm Head of Sales at Ortus, now in my 10th year, believe it or not, of looking at bridging finance deals.
Hi, and I'm Tom Anderson. I'm the Director for Scotland, responsible for working with our network of introducers north of the border, but I also look after our existing borrowers as well, from drawdown onwards.
Okay, wonderful. Thank you very much. So the topic that we'll be diving into is specialist property finance exit strategies. There's sometimes a misconception that specialist lenders and high street lenders are in direct competition with one another, when in actual fact we need that to be a synergistic relationship for all parties to prosper. Is this true in a COVID and lockdown world? Have we seen the support from the term lenders at the moment? It's widely known that they're obviously very preoccupied with government-backed loans at the moment. And where does that leave their usual commercial propositions? These are some of the things that we're going to be talking about, as well as how the restriction in appetite from those lenders is having an impact on specialist lenders' terms and criteria. So it's all very connected. There's a lot to talk about here. We would like to just start and jump right in and see how this community of brokers and lenders can possibly mitigate what is quite complicated waters at the moment. Richard, if it's okay, I'll start with you just for a general overview of the landscape as you see it in the term and specialist markets.
It's difficult for me to comment exactly because I'm not on the front line of placing borrowers' deals with lenders. What I can say from our point of view is that we are still getting repaid, which is obviously very important for us, especially for loans that we did 12, 15 months ago. And that's a variety of different funders paying us back, from challenger banks to the high street banks. Whilst the majority of our book now is residential, on the commercial side, we had Clydesdale repay us on a care home transaction recently, and we've also had other high street banks funding refinancing pubs that we've done. So whilst we recognise that brokers are very frustrated and it's probably taking people twice as long to achieve the same amount of work, the market is functioning. I suppose the one thing that we can't see at Ortus is what these refinance packages look like when the banks do deliver. Are borrowers having to put in a lot more security or additional security than they would have had to have done normally? That's something I think that Darren, Joe, Mike, and Brian could probably guide us on. But from one thing I'd say is that this month already we've had £15 million worth of loans repaid, which is a chunky number for us, and that's obviously very reassuring when you're a bridging lender to see your money coming back in.
Thanks, Richard. Joe, can you speak a bit to what those packages look like, what the appetite really is from a refinancing point of view?
Yeah, absolutely. I mean, in all fairness, I think it's an ever-changing environment. It's not really standing still. Over the last 10 months, we've obviously seen a huge change from pretty much the doors being closed overnight at the sort of announcement of the pandemic, through to now where gradually things are getting back to sort of where we were previously. We are seeing sort of, particularly with the specialist lenders, we're seeing the rates are coming down a bit. The LTVs are getting a bit higher. Some of them seem to have arrangement fees that are higher than we were used to. But very slowly and surely things are getting back to where they were. I guess there's you know, it's very much a case-by-case basis and a lender-to-lender basis. But there's obviously still nervousness around certain sectors. You know, student property, anything in retail and hospitality. There's still a way to go with that, clearly. But as Richard said, we are getting funding through. We are perhaps having to be a bit more tenacious than usual. And, you know, it's all in the communication with the clients and the lender to ensure we're getting, you know, the right package to repay bridging finance.
Darren, would you like to add to that?
Yeah, I agree largely with what Joe said there. I think perhaps the greatest challenge really is actually being able to actually get the high street turned on to actually having an appetite to do deals again. I think generally speaking, a lot of the lenders out there will say that they are open for business, that their policy hasn't changed, it's business as normal, and yet there seems to be a large swathe of the high street do not have the same appetite to do the deals that they might have done 12 months ago. That there's certain lenders that will say that they will start rating or grading deals now, and then when it's declined, they can't actually tell you why it's been declined. You've got 2 or 3 big high street names that have actually come out and said, you know, we aren't actually in the market, and they've been very honest with us as a firm of brokers. But you know, if you said that maybe the high street consists of, I don't know, 7 lenders, maybe, I think it'd probably be fair to say, and I'm sure some of the rest of the panel will agree, that perhaps 4 or possibly even 5 of them actually aren't open to the same level that they were 12 months ago. You know, there is always going to be exceptions. I'm sure real estate is something that we'll always still want to try and support. But I would be saying if you were doing a standalone single investment deal at the moment, very difficult to place. If you're doing anything in restaurant, hospitality, even go to as far as office, it can be very, very difficult. And that's why the growth in the market of specialist lenders, or what used to be classed as second tier lenders, you know, if we were talking about these guys 10 years ago, has certainly helped rescue the market. And as Joe rightly said, prices have been hardening on rates. I think what you've slowly but surely seen is that specialist lenders' rates have fallen a little bit, high streets have increased, and actually that middle ground is now not as large as it used to be. So still getting deals placed, but it is increasingly difficult, and it's all about educating both the introducer and the client as to what their expectation really is on what they can achieve in the market, which is what we all do as brokers.
John, what differences have you noted in underwriting as a specialist lender in light of the changes in what high street providers are happy to do right now?
I think that what we have seen is clients needing more time to jump over hurdles and maybe switch direction in their in their strategy of refinancing or restructuring or whatever it is they're doing. And our view is always, and again, it's to a certain extent, when we underwrite deals, maybe we do ask a couple more questions than certain other people in our sector do. And one of the reasons we do that is we're looking quite hard at client quality, we're looking quite hard at client experience, and all those softer factors, really for the very reason that we know that things like this happen. And I can't say that Ortus predicted the pandemic, because we absolutely didn't. But we do contain a section in our analysis where we're saying what problems has this person overcome before, and they can be business problems, they become personal problems, all sorts of things. How do they deal with problems? And then that kind of those kind of strengths come to the fore when you face with situations like this. But even the very best people need time. And what we found is that borrowers have come to us and said, will you give me time, because this is what I'm doing? The answer to that question is always, of course we will. And Colin runs that side of things for us, speaks to them, goes through their plan, and then gives them time to action it. And what we've noticed is that most of the clients, when we're talking about this 15 million of repayments, this is, you know, not many of that, not much of that would be, hey guys, just to let you know, it's coming back next week. Those will be ongoing conversations with clients to say, listen, you know, can I have another couple of weeks, because, you know, I had to change direction a few weeks ago, or my brokers had to provide more information, or we've had to come up with a much more detailed business plan, whatever it is. We can give them that time because of our funding lines. We've got long-term committed funding lines. We can make a decision. We can give people time. And I think one of the threats with this is solutions are there. Your quality brokers, like the people on this panel, they will find a solution as long as they're given the time to do so, as long as clients are pragmatic. I think one of the biggest dangers in this market is lenders in our sector, either through their own policy or through their lack of their own funding options, being authors of their own misfortune and authors of the client's misfortune, by forcing them into an Armageddon that they needn't have got into. So I think it's taking longer, it's more difficult, but it will happen if you're supportive.
Brian, what's your experience at the moment with borrowers and clients who were heading for a refinance to get out of their short-term facilities? What's happening on your side?
Well, I think it's just very much trying to understand what the route out is. If the business isn't trading at the moment, then when will it start to commence trading? We're speaking with a lot of lenders. I think probably a prime example at the moment of somebody we're doing a refinance on is a wedding venue business, which just simply isn't able to trade at the moment, isn't able to generate income, but historically traded for 12 years. It made fantastic underlying profits. It was well leveraged. It was lowly geared. Each of the high street banks we've spoken to and said, 12 months ago, we would have done this deal in a heartbeat. There's nothing we can touch at the moment because we don't have established profits. So we've shopped it around the market, and hospitality, as has been commented already, is persona non grata at the moment with funders. We don't have a huge depth of funders that want to take a view on it, but there are still funders that have a scope to take a common sense approach and will look at the wider connection, look at what the route is. The prime focus of the CBILS was to help businesses get through this pandemic, and if we're able to utilise that, give them 12 months, it's a wedding venue business. Is there anybody that will look at this and doesn't generally believe that weddings won't start to commence at some point in the next 12 months? Of course they will. And then the business will build back up and it will replicate what it's done before. So I think access to certain lenders is just is off the books at the moment. But if we go back to what Darren and Joe were saying, the high street banks will present a face to market that will say they're open for business, but the boots on the ground will tell you something very different. And it's very much a case of, yes, we might be open for business, but LTV, you might as well knock 5% off of the LTV, what we'd historically do. We'll be slightly more strict on our profitability criteria, and the deal will just need to be slightly more vanilla than it used to be to actually get any traction with funders at all. But we've got challenger banks that have now stepped into that space, which have taken up a huge proportion of those transactions which high street banks are failing the customers on at the moment.
Mike, would you agree that there are lenders that are filling the gaps left by the mainstream at the moment?
Yeah, no, absolutely. I mean, I echo a lot of what you guys have said previously. It's certainly been an interesting market. You know, something that we all have to keep our you know, ears to the ground on. You know, obviously things basically went to zero overnight at the start of the pandemic, and I think, you know, it's gone on for a lot longer than most of us had hoped for. And I think that's probably one thing that, you know, we need to kind of be cognizant of, is that I think probably the more positive of us, the more optimistic of us probably were hoping that things would have got back to normal towards the back end of last year. It's carried on. You know, at the start of this year, we've got as harsh a lockdown as we had, you know, in sort of March, April last year. And the lenders have had to kind of, you know, to some extent react to that and be ahead of that. And I think how quickly they bounce back from the first lockdown, and the fact that they haven't, you know, gone back to shutting up shop, you know, as what we saw in March, April, I think, you know, there's a credit to them. We've carried on, and yeah, you know, the high street banks and the clearing banks are definitely, you know, not lending as they were 12 months ago, but I don't think anyone could expect them to be doing that. They're super busy with CBILS. There's a lot going on, but yeah, I think the specialist lenders have gone into the breach. There are sort of more lenders out there that, you know, we might not have spoken to as much 12 months ago, you know, that do sit in the kind of, you know, as someone mentioned earlier, the old second tier, as it were, that are lending pretty well. I would say still quite cautious in the main. It's not as if they're, you know, biting your hand off to lend to retail, you know, businesses. They're not biting your hand off to lend to businesses that have had to shut up shop because of the restrictions. But I think what's really important, you know, as John mentioned earlier, for me, the most important thing, you know, when you are dealing with short-term lenders is getting someone on board who has flexibility, who isn't going to turn around and, you know, put penalties in place for having to extend for sort of 6 months. It's having an element of pragmatism. It's understanding that things are changing on a sort of monthly basis. You know, at some point it was changing on a daily basis. And yeah, just being able to work with them through the process. You know, I've got plenty of clients who, you know, we were all hopeful probably in sort of March, April, May, that we'd be back to normal pretty much by November, something like that, and it just hasn't happened. So, you know, you need to be with a short-term lender that has the ability to take a view, and you know, yeah, I'm sort of garbling it, but it for me, it's something it's a moving feast, and we can't sort of be too, you know, critical, I think, of these lenders. They're going to support where, you know, businesses are looking pretty strong, and I think, you know, sponsor-backed deals, you know, they're something that anyone's going to bite your hand off for at the moment. But yeah, I think there's money out there, and you know, it'll come to the right deals.
Is there the expectation, Darren, perhaps you'd like to comment on this, is the expectation or anticipation that the high street will come back to any sense of its former appetite once CBILS, BBLS, all of the government-backed loans end?
I think some of the issues that have been caused around people perhaps not offering traditional term debt is because maybe a lot of clients are actually using CBILS loans or bounce back loans as a replacement for what would have been traditional commercial debt that people would have taken in the past. If you're a bank and you're lending money out where effectively 80% of that debt is supported by a government-backed guarantee, there's an argument to say that is the safest way for them to lend money to perhaps cut down on their losses. And you can probably understand why you know, a bank wouldn't want to be lending to a retail or a hospitality business at this moment in time when it's closed. I mean, you know, the canons of lending that were kind of an old school way of assessing lending, then you can 100% agree with it. I think the other thing to consider is, and I was certainly talking to a major high street bank at the back end of last week, where they, I think, exceeded their lending target by 8 times So they'd lent 8 times more money this year than they had the previous year. So there is an argument to say, well, why would they want to necessarily dive back into the market? When CBILS ends in March, when hopefully, you know, businesses and things start getting back to normal, I think there will be an increase in appetite. But what my biggest fear, and this is kind of in an article that I wrote in May of last year, was that ultimately a lot of these businesses are going to have to start paying back CBILS and bounce back loans pretty much as of April. So I think we could see April, May, June being the real, you know, testing time for the economy, for businesses, for certainly people in our industry. And depending on how well that goes, if lenders are starting to see that these loans are being repaid back and there isn't huge debt, then I do think that they will start coming back into the market. But I think they're probably just sitting back and waiting and see at this moment in time. And that's not great news for us as an industry and for the brokers here and everything else. But you can actually understand, if you were in the bank's shoes, why you would be taking that approach. So hopefully, fingers crossed, they will. But I think it's a case of let's wait and see for the moment.
I also think what's different, slightly different about this crisis, if you want to call it that, to the last ones, is it's thrown in a really unusual practical challenge for large companies, of which all the banks, even the small ones, you know, fulfill. And I think at Ortus, in practical terms, we could and we did carry on as we did before. We'd had teams for ages. We already had offices. We had got Collins office up in Scotland, office in Belfast, Kingy in Manchester. We've always worked like this, so it didn't make any difference. I can only imagine what it's like if you've got 1,000 staff and suddenly you've got to shift from everyone, because even the last banking crash, at least everybody was there. At least it was easy to talk to somebody and pull together a meeting. I think this particular crisis, I think, has presented practical challenges in the way that no other has. And even if you just lose 5 or 10% of your productivity as a massive firm, that's really, really hard to deal with. Plus, if big chunks of your staff are sick, so I think one of the problems that maybe hasn't been, we look at banks and say, you are a bank, you have to deliver, which I think is fine, because they were also, let's not forget, they were also bailed out, and everyone remembers that. But I think in practical sense, it's been really challenging to run those businesses over the last 12 months. It must have been.
That's a good point. Yeah.
You've gone silent, Karen.
Karen, you're on mute.
Sorry, 10 months later and still on mute. Colin, what's the view from Scotland?
Very, very much the same. I mean, my role changed. My background was sort of Clydesdale Bank, Santander, so you can see what these guys are doing. They're very busy. You know, 8 times your lending. You know, you're having to focus on these guys and do the CBILS, and that takes, the whole process takes up a lot of time. So you can see why they've been slow to react and probably pulled out. But you know, we quickly recognised from day one that our clients needed support, and every single one got a phone call split up amongst the team from us saying, look, what can you do? How are things? Do you know what support's available? Are you closed? And through the course of that, those conversations have continued. And from my point of view, the borrower performance has been excellent. You know, the communication has been first class, and that's the key in all this. People need to speak to the lenders, keep in touch with them, tell them what's happening. But we also advised them what support was available. And Brian was talking about wedding venues. You know, there's, I think recently in the press or something, that there's going to be support for the wedding industry and that sort of thing. So those we would point that out to our borrowers who are in those fields. We did have a wedding venue part of the 15 million that got repaid. They were able to get a refinance. I think that was more they did have another business and it was off the back of that. But you know, we need to look at the positives and how things react. Look at the residential market; it's been really strong. When we came out of lockdown, you know, stamp duty's probably played a part, but people need to move on with their lives. You know, and I think that's where the recovery will come in terms of the B&Bs and hotels and pubs. People want to get back out, they want to go on holiday, they might not want to go abroad. So it's these businesses trying to survive until that comes out, and then the market will come back and people will decide that they want to move banks or they want to expand their business and they want to do something else. But you're still seeing the fact that deals have continued, sales have happened, refinances are there. You guys are still coming to us with new deals. There's still activity, and the quality of those deals, it's the same as before. There's some good ones, there's some not so good ones, there's some that need a bit of work and some that need a bit of digging. So, and Scotland's no different from that. The bridging market is probably not as mature as other parts of the UK, but we've still got a lot of inquiries. And in fact, since I've started looking after existing customers, there's been a few more of the deals in Scotland which have gone to other guys. That's a separate conversation.
Joe, just on the point about communicating and managing expectations of borrowers right now, how are you managing that when we don't necessarily have an end in sight or an answer as to when things might return to sense of normality?
Well, I guess that's quite a broad question, really, isn't it? And it's very much on a case-by-case basis. I mean, I guess there's communicating with clients that are already in a situation where they've got some bridging finance and they need to come out. And I guess then we can assess exactly what is available in the market at the moment and whether anything is going to meet their needs, and how we can sort of structure it to fit. And obviously, if there isn't anything, then it's working with the bridging company and hoping that there's some flexibility there, as John has quite rightly said, in terms of just being a little bit patient and giving the client a little bit more time to come back with the repayment method. And then I guess if we're in discussions with a client who's looking to go into bridging finance right now, then obviously it's so important, and we would always have followed this ethos that we're very, very clear right from the beginning that the exit plan is in place, that the expectation is realistic, and that it is doable. But obviously we can only work on what's available today, and clearly the exit might be in 12 months' time, and we don't know where we might be then. So I guess the whole communication thing is around managing expectations and making sure that the client is fully prepared for all eventualities, and that they understand that there is no guarantee. If someone's going into a bridge today, we cannot guarantee what there will be in 12 months' time for them to have as their exit plan. So we just need to make sure that everything is really, really clear to the client, and we also need to be very clear with the lender as well as to what the client's expectations are. So communication it always has been absolutely key. I guess it's probably even more important now.
Thanks, Joe. Richard, are you seeing a prevalence of rebridges / loan extensions, which I suppose is quite natural in the climate? But what does that mean for the market in the long term if we are seeing increased rebridging, for example?
Well, I'm certainly seeing some cases where borrowers with perfectly decent business plans and sensible strategies 18 months ago, 12 months ago, have been completely undone by the pandemic. I mean, only yesterday I've got a client. He was on a bridge. He bought a small hotel in the northwest near some football grounds. His business plan was basically putting up football fans when they came over to watch games at Old Trafford. So Wednesday nights, Sundays, Saturdays, whatever. They've put a lot of money into this hotel. It traded very briefly, did well. Then all of a sudden, there are no fans, and we're in a situation where this borrower just needs more time. So can he go today onto a sensible term loan? No. Can we buy him some time for 12 months? Absolutely yes. So there's definitely scenarios like that. What it means for the market long term, if there's lots more rebridging, well, I suppose it depends on your outlook. Some deals you'd be happy to rebridge. Other clients will find themselves at a level of gearing where they won't be able to get out, and that's a tragedy for them. And there could be a situation where lenders have lent money, haven't really thought about the plan B and been happy that repossession is an exit strategy. But that's something that we've never ever been wanting to do.
We've had a question in from one of our attendees centered around that and about experience and care or duty of care when it comes to lenders and brokers advising on a deal or lending on a deal where the exit isn't clear. Is there any excuse for that at this point? And how do we educate the market that this is going to end up in more loan prisoners, shall we say?
I wouldn't mind answering that just initially from a lender's perspective, because as an unregulated lender, which is what we and many of our competitors operate in, there is of course no duty of care, no legal duty of care. These are business loans, and we can't pretend there is. What brokers and borrowers have to do is ask the questions to see who their counterparty is in the same way that a lender does. And we do feel a duty of care at Ortus. We always have done, and it's not because there's anything written down in a law anywhere. It's because it's a question of right and wrong and how you want to spend your career and spend your life, and what you want to do each day. Do you want to do good or do you want to do harm? And I think that what the way we've always seen things is we know where it'll end up if things go wrong. Every single person on this call has seen that happen around them in this industry. So our view is, it's up to the brokers, and I don't mind getting questioned. I like getting questioned by brokers, and it happens a lot where brokers are saying, hold on a minute, I'm not telling you this deal's going to go wrong. I'm telling you that things can happen. And what will your approach be? Tell me how many times you've been forced in the last, you've been going 8 years. How many times have you been forced? The answer to that question is twice for us. And that should give people some comfort that we're not the sorts of people that do that. So I feel quite strongly about it, as you can probably tell. I think that borrowers are entitled to, for that. That's one of the things, and I know the brokers on this panel will hold lenders' feet to the fire on that very question, to say this is going to go well. Very confident, the borrower's very confident. If it doesn't, what am I dealing with? Because one thing we sometimes find, and it's very difficult, is a case will come to us, and as Kingy just said, a lot of the time during this COVID, cases have come to us, and we're thinking, if you'd come to us at the beginning, if you'd come to us in the first place, you'd be all right. The trouble is the damage that's been done in terms of your rolled up default interest to your structure and to your business is now making it hard for us to help you.
Darren, speaking on behalf of the entire broker community, what do you think?
Well, I think in terms of the word that was mentioned earlier on was duty of care. And as far as I'm concerned, and something that I would instill within hopefully all of the team at 2XL Commercial, that in reality, if we can put a client into a bridge, but we don't have a defined exit effectively from day one, then we don't transact the business. Because for me, and I accept the point everyone said there, that no one knows what in 12 months' time is going to bring. But the way I would assess it is that, and I actually had one yesterday where we were talking to the client about the bridge, and the bridge was available to them. They then asked me, well, what happens in 12 months' time? And my answer at that point was, well, we don't know what the lending market's going to look like in 12 months' time. If you would have asked me it 12 months earlier, I certainly wouldn't have predicted where we are now. But what I did say to the client is that if that particular deal was due to be refinanced into the marketplace as of today, then we could do that deal. So I think that duty of care has got to always come from us as a broker community first and foremost, so that when that deal then goes into, say, Ortus, that they know we've already underwritten that case. We've already looked at it. We've already talked to the client about exit. We've already talked to them about what might go wrong. And that really is the ones that separate the wheat from the chaff, as far as I'm concerned, in the broker community, because there'll be brokers out there that perhaps won't look at that, and they'll chase the big fee. They'll chase the fee at the start, the fee to get the deal done, and then ride off into the sunset. And as a firm, and I'm sure that's replicated for the other guys on the panel, that's not where we want to be. And I think certainly, I'm sure the likes of the guys from Ortus here want to deal with the likes of the people who are on this panel, on that basis, because we're responsible. We have a duty of care to the client, and yes, it might be classed as an unregulated market, but everybody in our business treats every deal in exactly the same way that an unregulated would, as a regulated one would be. And that's from a human perspective, but also with the guidance that we get. So yeah, for me, you know, we've got to look out for rogue type brokers and also rogue lenders in this market. And you know, the cream will rise to the top.
Mike, what are your
Yeah,
thoughts?
I think it's an ethical question, but
Sorry, go on. It's exactly what I was going to say.
sorry, I was just going to say also as a reputational risk question. Yeah. So from a reputational risk question, if we are looking to still be brokers in 10 years' time, putting deals into bridges with no exit is the easiest and fastest way to ruin your reputation within the community. So actually, yes, it's an ethical question. Yes, it's a duty of care question, but just to protect our own businesses, doing the right thing by the customers will hold stand us in good stead with the customers, but also with the lenders.
Mike, what are your thoughts on, I guess we're a lot busier as an industry right now trying to find solutions for borrowers that perhaps wouldn't have considered specialist finance before, and now they are. What comes along, again, to the other panelists' points about responsibility as a broker for these people who are in need at the moment?
Yeah, I mean, I think I touched on it earlier. It's about really keeping your ear to the ground on what's happening. You know, I think we can, to some extent, we can underwrite the exit all we want, but if the market changes massively within the 6 to 12 months of that loan, we have to be realistic that that can happen. And you know, as Darren said, none of us would have even have got close to predicting what would have happened 12 months ago. Maybe John would have done, and the guys at Ortus. But you know, it's one of those things where I think you can say, right, if you're putting a bridge in place, one of the biggest things that you can do for your client and that your client can do is to maybe put slightly less leverage onto that deal than they would like, with a mind to 12 months. You know, if you're refinancing a bridging loan at sort of 70-75% and something happens to the valuation between then and now, you know, understanding that, you know, valuers at the moment are, you know, understandably being quite cautious. You know, can you conceivably reduce that leverage that you require on that bridge now, with a view to in 12 months' time making it a bit easier? These kind of things. Having a plan B, just in case something unexpected happens. You know, contingency plans are always very useful. And also, as I mentioned before, you know, choosing the right counterparty, as John calls it, it's super important. You know, having a good relationship with that broker, with that lender, and with your broker is obviously very important. Because, you know, we've all heard about lenders, you know, maybe clients come to us and say, you know, we've been charged an exorbitant amount, or, you know, we've got a pretty heavy, you know, default fee, which is really hurting us. You know, these kind of things, you don't like to hear these kind of things, and it does hamstring people, and it basically gets clients to a point where, regardless of the intentions that we might have, it's going to be very difficult to help them out of a situation. So I think, you know, just being really open and honest with everyone, and saying, you know, there are things that you can do to make the next steps easier, but we can't guarantee anything. We just need to be very you know, realistic about that, and having plan Bs, and, you know, just ensuring that we're on top of it, really, is, I think that's the most important thing.
I think there's I think with some clients, say you have to rein a lot of them in, because you hear it all the time. Well, I'm definitely going to get planning on that, or this is definitely going to happen. And if you ask the question, well, what if it doesn't? Some of these borrowers might think you're a little bit mad. Well, of course it's going to happen. And it's like Darren said, there's no point putting someone into something, even if the product's there, if you're not comfortable that they'll be able to get out. And that might mean, well, I can do this loan for you at 65%, but I'm definitely not prepared to go to 70, 75. out of a duty of care. If you want to transact with me, that's great. Otherwise, I can't help. And I suppose that means being brave enough to let some business go by.
Yeah, for sure. Agreed.
Brian, what would you say about this concept of a quick no, and having communication flowing freely and willingly from providers rather than being, I suppose, dragged down the garden path only to have the facility fall over at the last hurdle?
That's a good question. It was the first thing I learned. Previously being a broker, I was a business development manager at a high street bank, and the very first thing I was told was a quick no is almost as good as a yes, because it saves a hell of a lot of time for brokers going down the garden path, as you say, providing a lot of information, getting hopes up, only to have them dashed 4 weeks later, when that could have been 3.5 weeks spent with a funder that has got the appetite to do it. So yes, that's why it's so important to deal with the right funders, but even more so deal with the right people at the right funders. And I think that most people would echo this. Relationship is absolutely key in our industries. So if we can have that open and honest discussion with the funders at the outset, this is the deal. These are the pitfalls of the deal. We understand where they are, but this is how we believe they're mitigated. And having that chat and getting a quick no saves a lot of time. And it changes deals that fall by the wayside or fall out of bed, as commonly rephrased, to actually being done, because you can find the right lender who's going to deliver on the deal sooner.
Joe,
Aaron,
do you?
can I just?
Yes.
Yeah, I was just going to say there. I mean, Mike said it'd like a plan B. I quite often would like a plan C, but I don't think it's not possible to predict every issue a client is going to face during the term of a loan, as have we seen over the last 12 months. But don't underestimate the quality and the experience of the borrowers. That's a huge point for us, because these are the people that will probably find alternative solutions if they do hit a problem, because they've probably been down the line before. So that's something that we do focus on. And I think if somebody's coming in and saying, I'm going to go into this industry, I have no experience, then, you know, those are the people to have the conversations with and just say, well, you know, how are your exits? Are you going to get funding? Whereas the ones that have been there and done it, it's all about the information gathering at the start and the information that you guys give us. That's hugely important. I think it makes a big difference, particularly in this, as we've seen over the last year.
I absolutely agree with you there, Colin. I think there's a huge amount of time that we spend up front with a client to fully understand exactly, you know, what their background is, what their experience is, what their expectations are, whether they're realistic or not. And, you know, we will work through with them in quite a lot of detail to establish, you know, just how viable we believe that, you know, that particular deal to be before we would go to a lender, so that we've already covered off all those bases and we've already put in place, you know, our sort of proposal in terms of the exit plan, etc. as well. And I think it's, you know, we are not in a transactional business, not even slightly. You know, this is very much all about sort of understanding exactly what a client is looking for and exactly what's available that will meet their needs.
Darren, what would you say to the idea, to Joe's point about experience and having it in your makeup and DNA as brokers to sit down with a client and hash things out and understand concepts like the exit, in the face of more brokers entering the specialist market as a result of what's going on in the general environment and not having that experience? How do we manage that as an industry when you've got these sort of new entrants to the space advising?
Blimey, there's a lot of questions in there, Karen. I think the key is, and I say this having had our business now for the best part of 15 years, is that from a brokerage perspective, you are only as good as your staff and you're only as good as your lenders. So ultimately, certainly within the team here, and I'm sure it's the same with the other guys, is we've got guys who have been in commercial lending 15, 20, 25, in some cases almost 30 years. So they are very adept at A, questioning the customer, B, understanding the customer's needs, but perhaps C, which is the bit that probably only comes from experience, is the ability to smell a rat when there may well be one, you know, and asking the right questions and the right pertinent questions to get the information out is always key. So I think the ability of the broker to actually understand the client properly and question the client, and it's not all about necessarily questioning the client just to massage their ego. It's about actually, you know, pointing out pitfalls that might be there in their business plan or in their potential proposition, so that they can become better rounded and understand what the bank, how the bank are going to view it, because actually that then puts questions in their own mind and actually educates the customer. You know, as brokers, we're not here just to place debt. We're here to pass on our experience and our knowledge to our clients, because ultimately that's what they're paying for. From the lender perspective, because I noticed it's a sort of question that's come up now with more, you know, more newer lenders coming into the market, and perhaps some brokers not having experience of working with them. You know, if you're an FCA regulated brokerage and, you know, you're members of the various trade bodies and everything else, you know, you should be putting your deal to a multitude of different lenders that are in the market. And ultimately that deal, I know it sounds quite crude, but that deal finds its place and finds its space. And if we go out to 15 lenders who we believe that are in the marketplace, and 5 reject it, 10 say they want to do it, and we present those 10 options clearly to the client, and we then follow that up with a recommendation letter as to why we want to do that deal, and the client signs it, the client goes through all the legal due diligence, we've done everything and more that we can for that client to get them the very best deal in the right way, following the right compliance, following the right regulation. Now, we've had an ethos within the business that we treat every deal, and it does cause us more paperwork, which some of the team won't thank me for, but we treat every unregulated deal in the same way as a regulated deal, to make sure that if anyone ever came and tapped us on the shoulder and said, show me your files, that we could demonstrate that we're doing things the right way. And there's an audit trail to prove that. I'm pretty sure everybody on this panel will be doing the same thing, but there's also a lot of people who play at commercial, who've never really done commercial, they've never really done bridging, and they think it's a way to make a fast buck. Well, you know, yes, we're remunerated well for deals that we do, but you know, we give that expert advice. I think the days of, and I used to quote this a long time ago, but the day of just picking up the phone to John at RBS and getting him to write your deal, you know, they're long gone. You know, the time involved in actually presenting a case and going through the right channels to get the client the right deal, you know, is now a lengthy process. You know, and whereas before, when I was a BDM at Lloyds Bank 15 years ago, you know, it would be a name and a phone number on the back of a fag packet from a broker, and you made the deal happen. You know, whereas the market, thankfully, has evolved for the better as far as the broker's market is concerned.
We still get those deals, Darren. Don't get me, believe me.
I also think from a lender's perspective,
You're welcome to the meeting.
It can be a bit controversial to say this maybe, but also I think from looking at the market, right, if you're a client, clients ultimately do, in the same way that sometimes you might look at a lawyer defending someone in court, and the lawyer doesn't really like them very much, doesn't maybe agree with them, but at the end of the day, that person has a right to be defended. And I think that if you might get a client who does take a lot of risk, they quite openly take a lot of risk, and there are lenders out there that are also happy to take a lot of risk. And maybe there are lenders out there that say, you know what, our exit is repossession. That is how we work. And the borrower's going, I'm fine with that because I'm going to back myself to do this. And if I don't, I will pay the price. And I think that there's lenders, okay, Ortus aren't in that camp, and maybe people on this panel don't deal with clients like that very often either. But I also think as lenders, we've got to be careful not to be sort of worthier than thou and think, right, well, this is how we operate, it's how Ortus operates, how a lot of our competitors operate. But clients out there that want to back themselves to take a load of risk, and lenders out there that are happy to take a load of risk, they have a right to be matched up with each other. And I think, as Darren said, as long as those borrowers are advised, as they are, and the paperwork's done, and they're told what risk they're taking, it's kind of an important part of the market, because there's a lot of very successful people that started off by taking a massive amount of risk and getting away with it.
Yeah.
Thank you
Yeah.
very much, John. I'm just going to, we're sort of nearing the end of the session, but I wanted to just do a quick run through our panel quickly for any final thoughts on the topic of exits, refinancing, the market in general. I think we've gone quite broad with the topic today, which is excellent. Brian, if I can ask you for your final thoughts.
Yeah, I think it's just it's not doom and gloom. Yes, we've seen a retrenchment, and I think we'll continue to see in the high street appetite, but there are other funders that are stepping into that space. The market is not dead, it's just moving, and as brokers, it's our job to keep up to date with what's going on in the market, what sentiment is, what appetite is, and again, like John says, match up the funders and their funding requirements with the clients that are able to sustain those. So I think our job has probably never been as important as it is at the moment.
Mike?
Yep, no, I totally agree, Brian. So, you know, as Darren said earlier as well, you know, gone are the days where we can just give it to one of the clearing banks and they'll underwrite the deal for you. You know, as things keep changing and shifting post-COVID, none of us really knows what's going to happen. All we know is that things will change. The market will open up again, probably retract again. New entrants to the market will come in, but I think that's where dealing with a good broker, you know, will be really, really useful for any client or any advisor, because that's really where we add our experience and value into the market. And you know, those of us who, I'm sure all of us on the call are like that, aren't viewing things in a transactional way. It's all, you know, relationship based. We're going to be looking out for the client throughout their whole life cycle. You know, we want to make sure we see them grow and we help them grow. And you know, that's what we're there to do. We're there to advise and sort of help them, you know, get from A to B, but also B to C, and so on and so forth. So yeah, there's no doubt going to be change, but change can be good. It often is good. Eventually, you know, all things happen for a reason.
Over to you, Joe.
Yeah, I absolutely agree with Mike and Brian. I think, you know, things are looking certainly a lot more positive now. And every month that goes by, I think we're seeing, you know, a bit more confidence in the market and increased appetite amongst lenders. And absolutely the sort of increase in growth of specialist lenders obviously gives us a lot more choice of where to go to. But as the other guys have said, you know, the importance of our role as a broker and as you know, researching the market and finding the best possible proposal for a client is absolutely imperative now.
Darren?
So it's probably threefold, really. I've just scribbled a couple of things down there because a lot of the guys have touched upon some of the points that I was going to raise. But I think from a client or a borrower position is pick your advisor carefully. You know, do a bit of research on the person that's actually going to be going out and trying to secure this funding for you. Be 100% upfront with them from the off, because you know a good broker can manage challenges and can manage issues and present them accordingly. But perhaps one for certainly that I'll be echoing to my team is don't be afraid to say no to a client. You know, because ultimately everyone thinks that as brokers we've got to get the client the money, we've got to do everything we can to get the money. Sometimes, sadly, getting them the money isn't the right solution, you know, and you know I'd rather say no there and then than in 12 months time have a client in a deal causing headaches for me, causing headaches for the lender, and as Brian touched upon, you know, the reputational risk comes into play. A lot of the time, if you've experienced at doing this, your gut instinct is often right, and that's something that I'd echo to the rest of the team.
Colin?
Yeah, I mean, I look at it slightly differently in terms of sort of giving people time. I mean, I think we need to recognise the support given by the government, along with our sort of sensible LTVs across our, in particular, our commercial portfolio. We've got the benefit of long-term committed funds, so that gives us a luxury of being able to give borrowers and the brokers more time to get an exit away.
I'd say that whilst it's obviously a challenge trying to get people off loans at the minute. It's not impossible, but also it's a double-edged sword, because with the banks not lending, these borrowers need professional advice, and if they can't get it off their bank, they then have to look for the broker community, and then that feeds down into other specialist lenders. So it's, despite the challenges of working from home and the lockdown, it's probably quite a good time to be a broker, and it will get a lot better when homeschooling ends. So that's my final comment on that. Because
indeed.
You get the feeling a lot of people that their lives are on hold because they've got to look after the kids, and if they're like me, they can't multitask, and so it's the deal with the kids, and perhaps I'll put my plans on hold for a couple of months. And I think, yeah, getting the kids back to school will be the best thing that can happen.
I'd like to finish on a positive note, and something that doesn't just relate to Ortus or the people on this panel, but to all of us, and I would say the vast majority of the people watching this as well, whether that's some of our excellent competitors, whether it's other brokers. I think that we can be very proud of what we've done as an industry. This industry in the last crash hadn't really been formed in the way it does now. It's been grown. It's grown by all of us on this panel, with the people watching. Karen, so you and your company played an absolutely massive role in this, and we've also been there, right, for so many people over the last 12 months, and we will be there still in 12 months' time as the country comes through this. Now, I'm not saying that the role of our sector is going to be recognised or deserves to be recognised or anything like that. It doesn't. It's money, right? But I think that we can also be very proud of ourselves that we have played a small but critically important role in this process, that we've been problem solvers. And I think people can feel motivated by that. It's been really, really hard, both for people's personal reasons, mental health, people have been sick, people have lost people, it's been awful. But I think we can all be very proud as a sector of the part we've played.
Thanks, John. I think that's a wonderful sentiment to end on. And I think if this conversation and the pragmatism shown by this panel is anything to go by, then that will continue this year. So it just leaves me to thank the panel very much for your time. I thought it was a great conversation, and definitely very pleased that was our first official roundtable. Thank you very much to Ortus. Colin, Richard, John, thank you for supporting us in this first one. Between myself and our editor, Beth Fisher, we will be hosting these regularly on various topics that affect all different parts of the specialist property market. But thanks very much, and thank you to all the attendees who were very engaged with questions. That's wonderful to see. We have a very inquisitive attendee base, which is excellent. And this video will be available to view online in the next few days as well. So if you'd like to share it with anyone that you think could benefit from the conversation, then please feel free to do so. But yes, thank you very much, and have a wonderful rest of your day.
Thank you.
Thank you.
Thanks.
Cheers. Thank you.
Cheers.